trading can be frustrating when you find a good trading opportunity that initially goes in your favor in profit, but then suddenly the profit starts fading away till the trade actually becomes a losing trade. In this video, I'll share with you my story on how I found a better way of determining the right take profit price so that I can be able to consistently lock in trading profits. But first of all, what is even a take profit price? So the take profit price is the price level that you determine beforehand that you want the trade to be able to close out in profit if the trade goes in your favor. So for example, if you buy something at 100 and you want that when it reaches the price level of 120, you want to close out the trade in profit, then the 120 price is actually your take profit price. So when I got started in trading, I found some entry strategies online, like for example, candlestick patterns. And when I found them, I was excited because now I said, now I know how to be able to make money online. So I need to go to the charts, find opportunities and start placing trades. But then the problem was, while I could find good trading opportunities, I didn't know how to determine the right price to be able to close out the trade if the trade actually went in my favor. So when I started out, the first approach that I actually decided to take was to base my take profit price on how much money I wanted to make in the trade. So I would enter a trade, let's say I would buy, let's say, a particular currency, then I would adjust my take profit price and leverage so that if I wanted, for example, to make $30, I would adjust my take profit price so that it actually matched up to $30. So I did that multiple times, but then unfortunately, the market would actually reverse and actually become a loss before hitting my take profit price for me to be able to make that arbitrary amount, or let's say $30 in that case. So I went online to try and figure out how to determine the right take profit price. So the next approach that I found was using a fixed take profit price of about 20 to 30 pips. So I was trading currencies, which is quite small. And the idea behind it is you lock in small profits when the market actually goes in your favor. So I started implementing that. I would place a trade, have a stop loss of about let's say 20 pips, but then have a take profit price of about 20 or 30 pips. So while it actually worked, I would actually be able to make those small profits of 20, 30 pips. I actually, over the long term, I was actually slowly losing money rather than making money because those small profits of 20, 30 pips were not enough to be able to cover any past losses that I would actually have. So the next approach that I actually took was one that I learned somewhere was when you're trading currencies, usually use what are called support and resistance levels. So these are levels whereby the market has reversed from in the past. So if I'm looking to buy, the advice was place your take profit price just before the next resistance level, or if it was the other way around, just before the support level. So while I would try to implement that, what used to happen was the market would go in my favor, I would be in profit, but then just before it would actually reach the resistance level, the market would actually reverse back more often. So that again did not work out. So I was still losing money trying to do that. So the next approach that I learned was about partial profits. So when it comes to partial profit, the idea is usually that you move your stop loss price close to the break-even point that you actually entered the market when the market starts going in your favor. So let's say, for example, I buy at a price of 100 and then I place my stop loss price, let's say, at 90. Like if the market reaches the price of 90, I want it to close automatically and so that I don't have a bigger loss. So when the market starts going in my favor, let's say from 100 to 105, I move my stop loss price very quickly to the break-even point, which at this point is my entry price at 100, and then I let the market actually then go in my favor. So while I implemented that approach of moving my stop loss to break-even when the market starts moving in my favor, I found more often than not, the price will actually reverse back to the entry point again, hit me at a break-even point. I will not lose any money, but then it would go ahead and hit higher profitable levels without me actually being in the trade. So at this particular point, I started getting frustrated because I know how to trade. I know how to identify candlestick patterns, entry signal, but then I can't seem to be able to make profits and hit any particular take profit price that I would actually try and actually implement. More often than not, I was actually losing money slowly rather than actually making money in the process. But then in the midst of all that frustration and confusion, I actually got to learn a better way of actually determining the most optimal take profit price to be able to enter. But before we check out this take profit formula, I'd like to share with you a free training that I created on the 7 steps to financial freedom through trading. So it's an amazing training that will give you a solid step-by-step plan on how you can actually start trading for a living. So if you'd like access to this particular free training, then sign up using the link on the pinned comment of this particular video or in the video description. Let's get back to the video. So the best approach that I actually found when it comes to determining the best take profit price to be able to use is actually called using a risk-based take profit formula. So what exactly does that mean? So what that means is that you determine your take profit price based on a multiple of your stop loss distance. So what this means is that before you actually determine the take profit price for your trade, you need to determine your stop loss price. And once you've determined your stop loss price, then that stop loss distance, the distance between the entry price and the stop loss price that you determine, that stop loss distance, you multiply it by a multiple, and then that will determine your take profit price. So let's look at an example just so that you can be able to understand this. So we'll use an example of gold, but this can work any other market that you actually trade, whether it's cryptos, currencies, stocks. You can be able to use the same approach, but we'll use the example of gold. So let's say, for example, you've identified an entry signal in gold, and you want to be able to buy gold at, let's say, a price of 1950. Let's say that's the entry price. Then you calculate your stop loss price and to be, let's say, at around 1900. So if you don't know how to calculate the stop loss price, so I've linked a video in the description of this particular video on how to actually determine the stop loss price. But once you determine your stop loss price, let's say 1900 for gold, you subtract the entry price of 1950 in this case minus 1900, you get that the stop loss distance is $50 in this particular case. So then to determine your take profit price, what you actually do, you multiply that particular stop loss distance, which is 50 by 2. So meaning 50 by 2 comes to 100. And this is very, very key. So the take profit multiple to be able to use is actually 2. You always multiply your stop loss distance by 2, and then that distance that you get, which is now your take profit distance, you add it to the entry price when you are buying, or if you are selling, you subtract it from the entry price. So in this particular example, you take the entry price that you had determined 1950, and then you add 100, which in this case is actually 2050. Your take profit price will be 2050, and your entry price is 1950, stop loss is 1900. So you might be wondering, why exactly did I actually say that you actually use a take profit multiple of 2? So let's look at different scenarios. Why not use 1? So that, for example, you actually take the stop loss distance, you multiply it by 1, and then that becomes your take profit price. So the reason why using just a multiple of 1 is not actually good is because most successful trading strategies have a win rate of between 40% to 50%, which more often than not means that you'll actually be having more losing trades than actually winning trades. So when you implement a take profit price that is just 1 times your stop loss distance, what that means is that if you've risked, let's say, $10 on a trade, you will actually make $10 if it goes in your favor. So over the long run, because most of your trades will be losing trades, let's say we take as a win rate of 40%, since like over a period of, let's say, 100 trades, you will lose 60, and then you will only win 40 trades. If you do 60 by the times 10, for example, in our example, you lose $600, and then on this other side, you will win 40 by 10, which is 400, meaning net, you'll actually be having a net loss of $200, yet you're actually just risking 1 times your take profit price. So using a 1-time take profit price, while it will be hit more often than not, you will find that you'll actually, at the very end of the period, still have a net loss because you are not making enough money to pay for your past losses. And then you might be asking me, then why not use 3 times or 4 times so that you can actually make even more money? So from my own tests and live trading, I've actually come to realize that when you target any take profit price above 3 times the stop loss distance, more often than not, that take profit price will not be hit. And the reason for this is because more often than not, markets reverse before they actually hit 3 times or more of your stop loss distance. So let's look at an example of how powerful using a 2 times your stop loss distance as the take profit price is actually a better way. So let's say, for example, you've entered a series of 100 trades and your strategy only wins 40% of the trades. So over a series of 100 trades, you will win 40, you will lose 60. And let's say, for example, your risk per trade is actually 1% per trade. So for the 60 trades, when you've lost them, you'd ideally have lost 60%. But then on the other side, since you are winning 2 times 1% actually means that every trade we are making 2%. What that means is that for our 40 trades, 40 by 2 comes to 80%. Meaning if you subtract what you make, 80%, minus the 60% that you lose, net, you've actually made a return of about 20%. So using this simple take profit price formula makes it easy to become a profitable trader.